Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the cost accounting 1, the first part. Hope you will like, share and subscribe our channel. Cost accounting 1, the first part. Cost accounting, the objective. Cost accounting systems are used as basic transaction reporting systems and for external financial reporting. Cost management systems, or simply CMS, not only provide reliable financial reporting but they also track costs in order to provide information for management decision making. The most important function of cost management is to help management focus on factors that make the firm successful. The management accountant is an integral part of management, identifying, summarizing, and reporting on the critical success factors that are necessary for the organization's success. Critical success factors are a limited number of characteristics, conditions, or variables that have a direct and important impact on the efficiency, effectiveness, and viability of an organization. They are the aspects of the company's performance that are essential to its competitive advantage and therefore to its success. Activities related to the critical success factors must be performed at the highest possible level of excellence. For example, the management accountant can provide information about the sources of the firm's competitive advantage, such as the cost, productivity, or efficiency advantage the firm has relative to competitors, or about the additional prices the company can charge for those additional features that makes it offering distinctive relative to the cost of adding those features. Strategic cost management is cost management that specifically focus on strategic issues such as these. The, Thus, cost management contributes to the company's object achieving its strategic goals and objectives. Types of cost accounting include standard costing, activity-based costing, lean accounting, and marginal costing. Cost accounting is not GAAP or IFRS compliant and can be used only for internal purposes. Cost accounting is a form of managerial accounting that aims to capture a company's total cost of production by assessing the variable cost of each step of production as well as fixed costs such as lease expense. Cost accounting is used internally by management in order to make fully informed business decisions. Unlike financial accounting, which provides information to external financial statement users, cost accounting is not required to adhere to set standards and can be flexible to meet the particular needs of the management. The cost accounting considers all input costs associated with production, which includes both the fixed and the variable costs. Effectiveness and efficiency. Importance in cost accounting. The difference between effectiveness and efficiency can be defined as follows. Effectiveness means doing the things right, whereas efficiency means doing the right things. Evaluating operating performance in determining whether a firm is achieving its goals and objectives. Two aspects of operations are important. That's effectiveness and efficiency. As there is a saying on strategic planning, a publicly owned for profit company must have maximizing shareholder value as its ultimate goal. The shareholders are the owners. They have provided risk capital with the expectation that the managers will pursue those strategies that will give them a good return on their investment. Thus, managers have an obligation to invest company profits in such a way that shareholders' value will be maximized. Effectiveness and efficiency are important aspects of fulfilling that obligation. An effective operation is one that achieves or exceeds the goals set for the operation. The ultimate goal is to maximize shareholders' value. Effectiveness in reaching its goal can be measured by analyzing the firm's critical success factors. Critical success factors may be a desired level of operating income, an increase in a market share, new products introduced, or a specified return on investments. The master budget states the desired operating income for the period and is a basic starting point for evaluating the effectiveness of the firm in attaining its profitability goals by comparing actual results with the planned results. An efficient operation is one that makes effective use of its resources in carrying out the operation. If the firm attained its goal of increasing sales but it spent more of its resources than necessary in attaining that goal, the firm may be effective but not efficient. Alternatively, a firm may be efficient in its resources, spending less than the plan per unit sold, but if the firm's goal for profitability and growth are not achieved because the sales are too low, then the firm was not effective. Difference between the costs and expenses. Cost and expenses are two different things. The main difference between cost and expenses are as follows. Cost are resources given up to achieve an objective, whereas expenses are costs that have been charged against revenue in a specific accounting period. Cost is an economic concept, whereas expenses is, of course, an accounting concept. Cost may not be an expense, but an expense is necessarily a cost before becoming cost, such as the cost of goods sold. In some cases, cost may never become expense, such as implicit cost opportunity cost, such as the time spent to close the deal in an organization. Maybe 4 hours is spent for closing the deal, which will never go into the accounts. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share and subscribe our channel Accounts and Finance with FARSK.